If you've been watching my videos for the past several months, it's going to be no surprise to you that, in my humble opinion, the stock market is headed higher. I've given you some evidence of that so far, but let me follow that up with additional evidence. So, let's take a look. All right, here we go. Number one, the Fed made its first rate cut recently, and since 1971, on average, following the first rate cut, the market is up 6 months later. Number two, the daily RSI recently fell below 30, and in 6 of the last 6 times this happened, the S&P 500 gained sharply. Number three, a one-day drop of 3%, which we had recently, has been a sign of panic ever since 2009. Number four, it's a bit more complicated, so follow me on this. The term structure of the CBOE Volatility Index, or the VIX, has inverted. You've heard about interest rate inversion. Well, let me tell you that when the VIX inverts, and I'm talking about the 1 month and the 4 month measure, out of the last 7 times that the VIX inverted, 5 of those times signaled the bottom as shown by this chart. The VIX term structure, or the VIX futures curve, is typically upward sloping, and an inverted curve generally reflects panic conditions and market capitulation. This is essentially a contrarian indicator, and according to Tom Lee of Fundstrat, he estimates that the markets tend to rise about 8.9% in the following 6 months after a VIX inversion. Number five, according to the American Association of Individual Investors, the recent sentiment reading, which is a contrarian indicator, suggests that the stock prices will rise over the next 6 months. And as shown by this chart, the recent bullish measure of 21.7% was nearly as low as it was on December 12, 2018, when the reading was at 20.9%. And we know what happened after that December low. Now, at the same time, the bearish sentiment is at a relative high, and both measures are favorable if you are a contrarian. Number six is this chart here, which is the National Association of Active Investment Managers Exposure Index. When investment managers turn bearish, they reduce their exposure and the index drops. As a contrarian, the reason to pay so much attention to sentiment indicators is that the market is never obvious and tends to fool the majority. The difficult part about interpreting sentiment is that sometimes the moves happen extremely quickly. Recently, the exposure index experienced an extreme drop to a reading of 56.59. For reference, the last time the index showed a similar reading was back in early June, and that was at the previous low. Now let's go into a bit more depth on the popular topic for Wall Street over the past several months, the yield curve inversion. And as we've discussed, the most widely watched gauge of the yield curve slope is a spread between the 2-year Treasury note yield and the 10-year Treasury note yield, which inverted recently. Now, this is touted as the clearest signal to date that the U.S. is set to face an economic recession. Now, that's some wonderful news depending upon who you are, but as usual, the media is a bit misleading because that's not the question we're interested in. The question for us as investors is what happens to the stock market when the yield curve inverts? Well, for the answer, you've come to the right place. While the yield inversion is not necessarily a great sign about the potential future economic conditions for everyone, a yield inversion doesn't necessarily mean we're headed for a stock market sell-off. So I'm showing you this chart here, and it indicates either this point is lost on the media and investors or someone wants to make fools of us. But as you can see, the stock market generally reacts favorable to an inversion over the time periods as shown, and this here shows the S&P 500 average performance following a 2-year/10-year yield curve inversion. And in each time frame, whether it be the 3 months later, 6 months, 1 year, 2 years, or 3 years, the S&P 500 on average is up. Now, I want to be clear that the market does not always head higher, as the previous chart showed the average returns. But since 1978, looking at this chart here, there have been 5 times that the 2s and 10s have inverted. And as this chart shows, in the vast majority of cases and time frames, the market is more favorable, at least if you're a long-term investor. And lastly is this chart from Bank of America strategist, whose Friday flow show highlights a contrarian signal telling investors to get ready. I'm telling you to be prepared. The key contrarian bull and bear indicator sank to 2.4 last week. The gauge is used to determine if investors are too negative or positive about stocks, with 0 being the most bearish and 10 being the most bullish. As the rule goes, if the reading is 8 or over, sell stocks. If it's 2 or under, buy stocks. And the chart shows a rating of 2.5, which was from early June. Again, the most recent reading was 2.4. But after the latest tweet storm from Trump last week, I'll bet the reading goes down again. So, in my contrarian opinion, be ready, be prepared. And for today, that's ChewDog Charts. Thank you.